and welcome fellow traders. We have a fantastic finishing lineup here today on the subject of trading volatility. We hear about it, we think we know what it is, CNBC talks about it all the time, and so how can we make money from it, trading the products intelligently? Here's what we're going to cover in the presentation over the next 45 minutes or so. Understanding what volatility and the VIX, the CBOE Volatility Index, really is. Contango, you might have heard that term before, but I'm going to show you very simply what it means and stacking the odds in your favor to make the contango work for you, profiting from the headwinds that it typically causes. I'm going to show you how to trade volatility ETFs with the charts, both long volatility and short volatility. When these set up properly, the odds are overwhelming in your favor. So whatever financial instrument you like to trade, stocks, options, futures, commodities, currencies, this is a trade that, unless you want to day trade them, which I'm going to show you how you can do that also, but more at market extremes, and at the extremes, it sets up incredible trading opportunities. And see this guy here with the money falling out of his pocket? Even if you, maybe if you have traded volatility products and you see volatility going up, but your open P&L is not going up, that's going to be because of the way these products are priced, unfortunately, to shake money out of the pockets of the uneducated. We want to put that money into your pocket. Now, Renee already gave a nice background on me, so I'm just going to jump to why I became a volatility trading expert. Sure, I've been trading options for 25 years. I learned the hard way, meaning trading options like a novice, not knowing what the heck I was doing, and then becoming a student of the markets to master them, to figure out what I was doing wrong. So I turned all of those errors around, and today, through my partner Greg Capper and I at Master Trader, we teach equity and option trading the proper way. And in fact, we actually have a free webinar at 4:30 today. I'll tell you a little bit about more on that. But I also used to trade volatility products, would get into a bullish trade and would lose money on it. I then became a consultant with a volatility hedge fund and learned everything I could from him, but I also taught him so much about our particular expertise using the charts and timing to master the trading of it. And I'm going to show you that right now. Let's start with, what is this CBOE? That's the Chicago Board Option Exchange. What is this volatility index? And what the heck do I do with it? I see it on CNBC all the time. The symbol is VIX, V-I-X. Okay, that's nice. What is it? It's measuring implied volatility of 30-day out S&P 500 volatility on the S&P 500. And then it's calculating a number, and we interpret it as either market fear or complacency. When people rush to the options market in fear, so they're buying puts out of fear or for protection, then the implied volatility in premium on those options goes up, causing the VIX to go up. And in terms of complacency, the volatility contracts. So this is showing you a weekly chart of the spiders above and of this VIX instrument below. Notice every time the market sells off, the bigger the better on the sell-off, volatility spikes because people are fearful and they're rushing to the option market to buy protection. So we can read we can read charts of volatility in the ETF instruments, just like we do of how we trade technical patterns of anything that moves. So now let's dig into how do I do that in the volatility world. Since you can't trade VIX, if you put it into your trading platform, you'll get a quote, but you can't buy or sell it. This is a summary of the key products that you can trade. So let's go from top to bottom, because the VIX futures are what all of these products are based off of, the valuation. So the VIX future /VX for you, and they have weeklies and monthlies. So what the heck is a VIX future? They're futures contracts on these forward 30-day implied volatilities of the S&P index. So since the VIX you can't trade, the VIX is calculated just by the computer looking at the implied volatility of the options on the S&P 500. These are actually futures contracts that buyers and sellers go to trade and speculate on the valuation of that particular month's futures expected volatility. ETFs. The VXX is a very good liquid volatility ETF that you can trade just like a stock. UVXY is the same thing, but it's a levered one. They're both optionable also, and since we love trading options because we get an additional edge, if you will, on our side, whether we're bullish or bearish, that gives us overwhelming odds to put on a profitable trade. But I will show you, as promised, how you could day trade these ETFs without having to worry about the options. And if you were day trading them, TVIX is another good instrument, but it's not optionable. And whenever you deal with levered ETFs, they're by definition going to be more illiquid and bigger spreads. So don't ever trade anything with big spreads. So this TVIX only if it's fairly tight. There's some inverse volatility ETFs, SVXY, and then XIV is another one, but it's not optionable. I'm going to show you here shortly how VIX options, how you can trade them, both long and short, and how they are priced off of this VIX future again. And then you're going to see the huge contango, both challenge or opportunity, depending if you're trading with or against it. But this contango occurs over 90% of the time, and as I would have to say, is the #1 reason why people who are long or bullish volatility lose, because they are swimming upstream, which I'm going to explain to you right now. So what is this word contango? I don't care if you memorize the definition, but I'm going to explain very simply what it is and again, the dangers and opportunities around it. So if you were to go to this website right here, VIXCentral.com, it's going to show you what they call this term structure. And very simply, all it's doing, on the prior page, we just defined for you what a VIX future was. These are all of the VIX futures month by month. You can see the amounts here and the months down here. Every further month is more expensive than the preceding. They're trading at a premium. What I refer to here is the spot price of VIX is that CBOE volatility index VIX that you can't trade. So in this particular example, back here in early August, it was trading at 9.20. That is like multi-decade lows. It's very low because we've had a big post-presidential rally with a lot of complacency out there. So it's 9.20 in this example, but if you're wanting to trade a volatility product to try to profit from this 9.20 going higher, the products that you're buying have this massive contango in them. So you have to be right on your timing, or else these headwinds are gonna eat into your profits. So just to better understand how this occurs, and it's not fraud or anything like that, where, and I've had many stories like that. I've had friends buy these commodity-based ETFs, whether it's volatility or oil or the DBC commodities, and they're like, damn, they're extremely mad. They're saying, look, oil went up 30%. Volatility, I'm reading in the newspaper, just went up 40% in the last X number of days, and my volatility ETF is only gone up 10%. Then they're yelling fraud. And it's not fraud, it's the way these things are priced on the future VIX future. So if you're the hedge fund manager for this, a volatility ETF, so the VXX or the UVXY, you are delivering to the market this ETF for people like you and me to trade, but for you to provide this product for you and me to trade, that not the hedge fund god, sorry, the ETF manager has to buy these 30-day out futures and continuously roll them. And so that manager is rolling these products out at more expensive prices when there is contango. So if he has to liquidate his August expiration at $9.20 and then go replace his futures at $12.43, then he just booked a massive loss in the valuation of that ETF. And that, ladies and gentlemen, is this contango headwinds that burns most volatility traders. Buying volatility, I'm going to show you how to do it with the charts, the master trader way. Many novice traders and newsletter writers, in my experience, they're just clueless about these vicious headwinds. I see, you know, people send me newsletters all the time, and I just see newsletter people saying buying the VXX is an excellent opportunity to get ready for a market downturn, but they never talk about proper timing. So it's the burning the hole in your pocket of this contango that hurts you. Now, there's a saying on Wall Street that says, when the VIX is high, that's the fear index, remember? So the market's crashing, VIX is high, it's time to buy. The buy referring to the market. Like when there's, I'll say it another way, when there's blood on the street, we're looking for buying opportunities. So I'm the same way. I'm a wonderful contrarian when things line up in accordance with our trading plan. But then here's the part I take disagreement with. When the VIX is low, it's time to go. And what that means in the option world historically was, hey, when the volatility is at decade lows like it is today, some people just automatically say it's time to short the market. And that's what I vehemently disagree with. We do not short the market until the spiders show us a bearish reason to short, and the VIX shows us a bullish reason that fear is going to increase. And I'm going to show you a number of examples coming up. So these products, they're just priced. Again, not fraud. It's because of the futures market and that term structure I just showed you. They're priced where the majority of the people are going to lose. I don't know if any of you have watched this movie, A Bronx Tale, but it's really funny. This old guy, Mush here, loves to gamble on the horses. And there was this one scene where all of his buddies will mush every single horse he bet on he would lose. And one day, a couple of his buddies noticed that Mush actually was betting on the same horse they were. And he was so consistently wrong that once they found that out, they ripped up their tickets and left without even waiting to see who won the race. So we're going to teach you briefly today, and then we have a specialty course on this to tell you about. Is we're going to teach you how to take Mush's trades, to take the other side of his bet. Here's a weekly chart of the spiders on top and of the UVXY on the bottom. Now recall from our earlier slide, the UVXY is the double levered ETF, so it's 2x of VXX, and it's the ETF's stock way of trading the VIX futures. So you don't have to mess with the VIX futures market. That's what this ETFs manager's job is doing. But because of that contango happening over 90% of the time, look at these charts. They're very self-explanatory. This is a multi-month sideways consolidation in the spiders. They didn't break out, they didn't break down, they're just in a consolidation coma. If you were long volatility under the belief of, hey, volatility is low, it has nowhere to go but up. Hey, CNBC's, all they do is they're talking about how low volatility is. These newsletters are telling me to buy UVXY. Well, guess what? Here's your present for doing that. Just eyeballing this, because these UVX products and these ETFs, they're meant to go to zero all the time because of the way they're valued. So they're always doing these reverse splits. So back here, it was, let's just say $400. A couple months later, it's 150. You've lost over over 50% of your bullish investment in UVXY. When the market does sell off, there are great opportunities to go long volatility, but you have to use the charts for your perfect timing. You do not ever buy volatility simply under the belief of, I think it's low. Now, could you get, and unless you like playing the lottery, if you think, yeah, I know it's low, yeah, Dan, I see your contango, thanks so much. I didn't appreciate it as much earlier, but I just think there's going to be a rocket man maybe launching a missile one day, or the government doing something. If you want to buy a lottery ticket for some huge unknown event that's going to spook the market, then yeah, you will get paid. But our approach is to wait to put on a long trade until it's lined up with the charts. So you can just see, the spikes you can trade on this rally. It went nothing but down. You had a 2-week little spike here where it tried to get out of this base. All it did was go down from there, with the market going sideways. And you can see it right there. Here's the long-term picture, the monthly chart, weekly and monthly, of this UVXY, just to put it in multi-year perspective. Does this chart to you look like it's meant to go up, down, or sideways? It does not take a magician to look at this and say, yeah, I see the very short-term spikes, but that is going nowhere but down over the long haul. And that's an absolutely correct statement because of these unavoidable headwinds. Now, for those of you who might know of this whack-a-mole game. You see it at the circus, or your kids play it on the TV, whatever the case. It's, you know, this little mole, every time he pops his head, we whack it. Now, do we do that arbitrarily like the game? No, but it's a good analogy, because I'm going to teach you in this course and a little bit today, the mindset is every time it spikes, you get ready to pound it. We'll give you the exact timing on when to do it, but your mindset is, you know, rally, spike. As soon as that thing spikes high and tires out, get ready for a whacking. So if I have bearish strategies I want to deploy on volatility because of these 90% contango headwinds, this is my abbreviated little toolbox. I'm going to be looking to swing or day trade UVXY, spiders, you know, coupled with the market internals that we use. Bearish option strategies, I'm going to do the bear call spreads. I'm going to buy in the money puts. I'm going to, and we prefer these spreads better than naked, because when you buy, even if you're putting on a bearish position, you're paying a lot of money to participate in this game. But by selling an out of the money put against it, we're putting the contango benefit in our favor with positive, what's called time decay. And what that means is we aren't getting punished for that huge contango, just to put it in layman's term. Here's a chart. Actually, this was leading right up to the Trump presidency notice. So the market was selling off into the election night last November. We have, so here's UVXY on the right side. We have a climactic sell set up on volatility. Look at this thing, just eyeball it. It went from 65 to 105, timed with the charts. Now, I actually took an initial position into the election because these were in alignment, but I was prepared that if this went against me to add to the position. But for a new trade, the S&P gapped up the next day on the election. It was a big gap, so it wasn't easy to get on board, but the proper trade was a 30-minute high. So as soon as the S&P made a 30-minute high, the spiders, you could short your bearish option strategies on UVXY under a 30-minute low. That's how we use the charts of the spiders and UVXY to put on our bullish and bearish volatility ETF trades. Now for you day traders, I actually have a number of clients who make a living at doing this. And I'm going to show you in this one slide, in simple terms, how to do that. All you do is line up the S&P. You're waiting for a bullish pattern in the S&P, 5-minute chart, with a bearish pattern on UVXY or VXX. Or if you're using an inverse, they would both be bullish, but you get the point. And you short it. So here, the market tried to break down, it didn't. You could short it. The market consolidated, it broke out, broke down, short it. Now, could you do the opposite of this as day trading, meaning when the spiders are bearish, you buy volatility if it's bullish? Absolutely, without a doubt. But I prefer even day trading shorting because of contango again. So these headwinds even work to your favor in shorting volatility intraday. Let's talk about these VIX options. So you saw this term structure earlier. So this is just a different example I'm going to show you, a more recent one. Now, again, just put it in simple terms. This is a complicated subject. I understand that, but I'm hopefully just in this 45-minute presentation making you walk away with a lot of aha moments of, oh my God, I can't believe I was so dumb before, or now I see what I can do to fix that, etc. But just look at these two numbers, folks. Here's my spot VIX again, 10.13. This number must converge with this number. This is the front month VIX future, 13.4 at expiration. That's less than a month because I'm talking about the front month. So there's opportunity there. That's a massive spread. Let's look at the math. So this was on September 1. The VIX was at 1013 that I just showed you. And since the VIX options are always tied to the corresponding VIX future, that's what active means. It just means the monthly one as opposed to the weekly. So this 1320 has to go to 1013. Well, it doesn't go to 1013 unless the VIX closes at 1013, but it has to go to spot at expiration. In this example, the spread here was massive. There was a 30% difference of these two numbers in less than a week. That is the market telling me that people are paying up tremendously for this front month VIX future. They want to be long volatility at all costs. But we are chart readers and we do what I'm talking about to you right now. So just showing you the math here is all. Let's say I wanted to buy a $12 put on this VIX future. Even though it's out of the money right now, because I'm buying an option to sell this VIX future, and it's 1320, I have the right to sell it at $12, so it's out of the money. But if this VIX spot at 1013, just hypothetically, goes 100% sideways for the next 16 days, that's days to expiration, which is this big number, then my $12 put will be in the money by how much? $1.87. How do I get that number? Well, my $12 put, I have the right to sell at 12. It's at 1013, so it's $1.87 in the money. I only paid 40 cents for this contract, so I've made over 360% ROI in 16 days, assuming it went sideways. If the volatility rallied and this expired above 12 at expiration, then I've lost my 40 cents. I understand that. But if you were buying volatility with these numbers, you have to be extremely accurate. Now, actually this morning, this is from Tasty Trade, which produces wonderful, good research content. So I'm not bashing them, but this just hit my inbox this morning, and I said, great. And somebody actually, one of Master Trader clients, emailed it to me asking me a couple questions, and I said, let me just make a quick slide for you all today because these are current numbers. So this came out this morning, and here's what it said. If you think the VIX futures for November, 15 days to expiration, if you want to take a bullish trade on it, they're just saying, hey, you might want to consider shorting an $11 November put. So let's go over the math, because maybe, and if we had more time, I would pause the screen and I would turn this into a quiz and I would ask you a couple questions, but we don't have the time, so we're going to do it together. So here we go. The VIX, when I just copied these values pre-market. So the VIX, now you know what the VIX is, CBOE Volatility Index, which you can see on CNBC, but you can't trade it, was at 10.01. Any ETF or VIX options is based off of this futures contract for November. Obviously, you can buy further out months. So it was trading at 11:45 pre-market when I grabbed this screen. So if you were to sell this $11 put that this newsletter is mentioning here, your break even at expiration is this VIX number right here. Well, let me back up and define again what a put is for maybe some of those that don't understand options as much. When you buy a put, you're, like we did in the prior slide, we're paying money for the right but not the obligation to sell something. So when we're selling this put, we're putting money in our pocket for the obligation to buy something at an agreed upon strike price on or before expiration. So we're putting 55 cents a share in our pocket. So I'm now asking you, what is your break even on this trade? Well, if I'm obligating myself to buy volatility at $11 a share, and I've put 55 cents a share in my pocket, then my break even is 10.45. But here's also what I wanted to highlight for you. Your break even compared to this spot VIX is 3.9% higher than it was when I grabbed this screenshot. Now again, I'm not saying this trade won't work or not. I'm just using this to show you and explain everything we've been talking about here and to work through the numbers. So if VIX closes at this 10.01 and just goes 100% sideways and ends at that number in the next 15 days, then your short $11 put, you're actually now losing 44 cents a share. So that's all. I'm not commenting on the validity of the trade. I just wanted to work through those numbers because this is the point that I have to drill into people, that the option pricing on these VIX options is based upon the VIX future, not this, not the spot market. So the VIX options, again, they're based off this 11.45, which is constantly moving around, but has that huge contango that we keep talking about. So now, what about contango in other commodity ETFs? If you just think about it, this contango is normal because if you're wanting to speculate on commodities, then people are willing to pay a premium. You don't want to buy a carload of cotton or tank loads of oil. So you're going to the futures market to either speculate or hedge as those products go up or down. But so you have to pay a premium to avoid the inconvenience and cost with transporting that oil or cotton and storing and insuring them in a warehouse. So that's also why the contango is normal, with future prices being higher over time. But even on these products, so any ETF that is trying to replicate the commodity by investing in futures contracts, so the VXX, which we've just spoken about for the last 40 minutes, and UVX, you know, all those products that I listed out. Even oil, USO, they have these same contango problems because they are based off of oil futures contracts, which are typically also in contango, everything else normal. Now, backwardation means future months are cheaper than prior months. How would that happen? One of two ways. You get a massive spike in the current price where then the futures traders are expecting prices to come down. So futures months are cheaper than they are today. A second reason is because many of these commodities their valuations are fundamental. You know, natural gas is gonna go up more in the winter months. Orange juice is gonna be affected by you know, disasters and floods in Florida where we have a lot of orange trees. Oil is gonna be impacted if there's war in the Middle East or embargoes, you know, et cetera. So I think you get the idea of that. But before you trade or invest in any of these commodity ETFs, just do yourself a favor and go over to Yahoo Finance and just at a minimum, go read their profile and see how heavily tied into these futures they are in offering you this ETF on a platter for you to trade. And that's the contango you have to be concerned about, because they're going to be converging to the spot price at expiration. So as the ETF manager is rolling those futures out into future months, it's the contango headwind drag. So just quick review. So you understand now VIX. I've given you a nice list of volatility products and how they're priced on the VIX future. You can go long or short. These profiting from contango headwinds and any of these futures-based ETFs. So my personal preference is the whack-a-mole game. Whenever it rallies, wait for my setup, both on the ETF and the spiders. And I'm shorting my bearish option strategies. That's my favorite. But for going long volatility, just time them with precision to the charts. And even on profit taking, you don't want to stick around for a long time. If you're just swing trading a pop in volatility, most of the time it's a 2 to 3 day trade, and then you're out. So don't sit on these products if you're long, because time is against you. And finally, you know, we talked about some of those other commodity-based ETF products. So I hope that intro gave you phenomenal information in 45 minutes, but I've been studying this subject and trading these things for many years. And so after a year in the making, I finally came up with this volatility ETF and options class. We have it, it's an online class. It's 75 PowerPoint slides. It's about a 4-hour course. You're going to learn everything we just touched upon here, but in great detail. The term structure, both up and down, that we'll get into some backwardation, how to trade even the S&P around it, et cetera, et cetera. So if you're interested in that, it's typically, and here's some what of our recent graduates provided. Those are some nice comments. You get the class recording. We have follow-up review and coaching with me. You get a month of our advisory letter, and we're discounting it for you graduates here, for you attendees today, $249. So if that interests you, you can pull up this URL or email me, dan@mastertrader.com. And finally, as I mentioned, my partner Greg Capra and I of Master Trader, we're having this informational webinar discussing trading both equities and options. We aren't going to get into the volatility per se. This is just how we approach the market and use options around the charts to recommend superior reward to risk trades. So tune in at 4:30 to Master Trader free webinar. And I think they're going to post a link for that in the chat. Yeah, there it is. So Renee, thank you. She posted a link for that if you want to stick around and for 30 minutes or still sign up for it, and we will send you a recording of it. So Renee, I'm right on time. Thanks for everybody attending, and we look forward to participating again or seeing you at a future webinar, either with Investor Inspiration or over at Master Trader. Happy trading, everybody.